In this lesson, we will look at the general framework of a financial due diligence report. When outlining the structure of a financial due diligence report, you might tailor the scope to the specific attributes of the transaction in question. In this topic, assuming that commercial due diligence is conducted separately, we will discuss three key areas: evaluation of assets and liabilities, performance analysis, and synergistic projections with the acquiring entity. 1. Scrutinizing assets and liabilities. The focus here is on validating asset valuations against current market standards and confirming the accuracy of liabilities. This process is critical to ensure a transparent depiction of the company's financial standing. Far from being a mere formality, this phase is instrumental in identifying hidden liabilities or overvalued assets that could distort the true value of the business. 2. Performance analysis. Investigating historical earnings goes beyond a simple profit and loss examination. It involves a deep dive into the quality of earnings. The goal is to ascertain a normalized EBITDA, a crucial indicator of the company's operational profitability, devoid of irregularities. This forms a sound foundation for an objective valuation. 3. Synergy and post-merger integration forecasting. The inclusion of this aspect in the FDD report is contingent upon your specific requirements. Nevertheless, post-acquisition synergy estimation requires a detailed forecast of potential operational efficiencies and revenue enhancements. This analysis is pivotal in shaping post-merger integration strategies and adjusting valuations where necessary. Debt-side due diligence. The examination of liabilities entails a thorough analysis to determine the veracity of the reported figures, from short-term payables to long-term financial commitments. For short-term liabilities, you will scrutinize accounts payable, outstanding expenses, and short-term loans. Evaluate the aging schedule of payables to identify overdue liabilities or abnormal payment terms. Examine recent changes in creditors' terms and assess the liquidity risk posed by short-term obligations. For long-term liabilities, you will analyze long-term debt agreements for terms, interest rates, and repayment schedules. Investigate lease obligations, pension liabilities, and other long-term commitments that could impact future cash flows. Review any contingent liabilities like legal disputes or warranty obligations that may materialize as future outlays. For off-balance sheet obligations, you will delve into commitments not recorded on the balance sheet, such as operating leases or contingent liabilities. Conduct interviews with management to unearth any undisclosed or contingent liabilities. Evaluate the impact of these off-balance sheet items on the company's financial health and future obligations. Impact on valuation. Discovering higher than reported liabilities should lower the valuation due to increased immediate financial commitments. In particular, unearthing more off-balance sheet obligations than anticipated leads to a downward adjustment in valuation. Overall, any unexpected increase in liabilities, short-term or long-term, diminishes the perceived value of a company.